Something just happened in the financial markets that hasn't occurred in over 15 years, and if you have any money invested right now, you need to hear this. Gold, the asset that people have trusted for literally thousands of years, the thing everyone runs to when the world seems like it's falling apart, is being sold off at a pace that's making even the most experienced traders stop and stare. And at the exact same time, stocks are absolutely exploding upward. This isn't normal. This isn't what's supposed to happen. And by the end of this video, you're going to understand why this might be the single most important shift in the markets that you'll witness this entire decade. But before we dive into this story, if you're someone who wants to actually understand what's happening with your money, instead of just blindly trusting what some talking head on cable news tells you, do me a favor right now and smash that subscribe button and hit the notification bell. I break down complex financial stories like this every single week in a way that actually makes sense. And trust me, you're going to want to be here for what's coming next. Seriously, subscribe right now because what I'm about to show you is going to change how you think about investing forever. So let's set the scene here. For the past few years, gold has been the golden child of investing, pun absolutely intended. When COVID hit and the world shut down, people bought gold. When inflation started creeping up and your grocery bills doubled, people bought gold. When banks started failing last year and everyone panicked, people bought gold. It's been the playbook, right? Uncertainty equals gold. Fear equals gold. Economic instability equals gold. That's what we've been taught. That's what's worked for generations. But something shifted in the last few weeks, and it happened so fast that most people didn't even notice it. Here's what's actually going down right now. Investors, and I'm talking about the big players, the institutional money managers, the hedge funds, the pension funds that move markets, they're dumping gold at a rate we haven't seen since before the 2008 financial crisis. We're talking billions of dollars flowing out of gold, ETFs, gold futures, physical gold holdings, everything. And where's that money going? Straight into stocks. The S&P 500 just hit another all-time high. The NASDAQ is on an absolute tear. Tech stocks are going parabolic. Small caps are waking up from their multi-year slumber. It's like someone flipped a switch and suddenly everyone decided that the thing that kept them safe doesn't matter anymore. Now, you might be thinking, okay, so what? Markets go up, markets go down, money moves around. That's just what happens, right? Wrong. This is different, and here's why. Gold and stocks aren't supposed to move like this together, or rather, they're not supposed to move in opposite directions this dramatically all at once. Normally, when stocks are ripping higher, gold kind of just sits there or slowly declines. When stocks crash, gold spikes because it's the safe haven. But what we're seeing right now is an aggressive, almost violent rotation out of gold and into equities. And it's happening at a speed that suggests something bigger is at play, something that the smart money knows that maybe you and I are just now figuring out. Let me paint you a picture of what this looks like in real numbers because this is where it gets wild. In just the past month alone, gold prices dropped nearly 8% from their recent highs. That might not sound like much, but for gold, which is supposed to be stable and slow moving, that's massive. We're talking about an asset that people buy specifically because it doesn't move like this. Meanwhile, gold ETFs saw outflows of over $3 billion in that same time frame. $3 billion. That's not retail investors panic selling their couple of coins. That's institutional money making a calculated decision to exit. And on the flip side, equity funds saw inflows of nearly $15 billion. The money isn't disappearing. It's rotating fast. So the obvious question is, why now? What changed? What did these big investors know that caused this sudden shift? And here's where the story gets really interesting, because the answer isn't just one thing. It's a perfect storm of factors that all came together at the exact same time. And when you see them all laid out, it's actually kind of terrifying how much sense it makes. But it's also the kind of information that could completely change your investment strategy going forward, so pay close attention here. The first major factor is interest rates, but not in the way you might think. See, for the last 2 years, everyone's been obsessed with when the Federal Reserve is going to cut rates. Lower rates mean cheaper borrowing, more economic growth, higher stock prices. That's been the narrative. But here's the twist. The market has suddenly started believing, really believing, that rate cuts are coming soon and that they're going to be significant. Why does this matter for gold? Because gold doesn't pay interest. It doesn't give you dividends. It just sits there. When interest rates are high, the opportunity cost of holding gold becomes expensive. You could have that money in bonds earning 5%, but instead it's in gold earning nothing. So when investors believe rates are about to drop, but before they actually do, there's this weird window where stocks become incredibly attractive because they're pricing in future growth, while gold becomes less attractive because the fear trade is off. We're in that window right now. But it goes deeper than just interest rates. The second factor, and this one's huge, is artificial intelligence. Now stick with me because I know AI is the buzzword that everyone's tired of hearing, but the money flowing into AI-related stocks right now is absolutely bonkers. We're not just talking about NVIDIA anymore, although yes, NVIDIA is still printing money. We're talking about an entire ecosystem of companies, from semiconductor manufacturers to data center operators to software companies to energy providers, all benefiting from this AI boom. And here's the key point. Investors are looking at AI not as a hype cycle, but as a genuine productivity revolution that's going to drive corporate earnings for the next decade. When you believe that earnings are going to explode, you don't want to be sitting in gold. You want to be in the companies that are going to capture that value. So money is pouring out of safe, boring, no-yield gold and into high-growth, high-potential equity positions. The third factor, and this one's probably the most controversial, is geopolitical stability, or at least the perception of it. This sounds crazy when you say it out loud, because if you turn on the news, the world seems like it's on fire, but here's what the markets are actually seeing. Major geopolitical risks that had everyone on edge, things like tensions in the Middle East, the situation in Ukraine, concerns about China and Taiwan. They're all still there, but they've reached a kind of stasis. Nothing's getting dramatically worse. There's no immediate crisis that looks like it's going to spiral out of control tomorrow. And in the world of finance, no news is good news. When investors aren't actively worried about the world ending, they don't need gold as an insurance policy. They can take that insurance money and put it to work in assets that actually generate returns. It's cold, it's calculated, but that's how the game works. Now, here's where things get even more interesting, and this is the part that should really make you think. There's a fourth factor that almost nobody is talking about, but it might be the most important one of all. Central banks around the world, the same ones that were massive buyers of gold for years, have slowed down their purchases dramatically. China, Russia, Turkey, Poland, these countries were stacking gold like it was going out of style, diversifying away from the dollar, building reserves, preparing for whatever economic uncertainty was coming. But recent data shows that central bank gold buying has dropped significantly in the last few quarters. Why? Some analysts think it's because they've already accumulated enough. Others think it's because they need to preserve cash for other priorities. But whatever the reason, when central banks stop buying, that's a huge source of demand that just vanishes. And markets are forward-looking. They saw this slowdown coming and started adjusting positions before most people even noticed. So now we've got this situation where all these factors, lower expected interest rates, the AI boom, stabilized geopolitics, and reduced central bank buying, they've all converged at once. And the result is what we're seeing right now, a historic rotation out of gold and into stocks. But here's the thing that should keep you up at night. Is this sustainable? Or are we watching investors make a massive mistake in real time? Because history is littered with examples of smart money being wrong, of markets getting too confident, of everyone piling into one side of the boat right before it tips over. Let me give you some context here. The last time we saw a rotation this aggressive was in late 2006 and early 2007. Remember what happened next? The housing market collapsed. The financial system nearly imploded. Stocks crashed. And gold? Gold went on an absolute moon mission, nearly tripling in price over the next few years as everyone scrambled back into safety. Now, I'm not saying that's about to happen again. The circumstances are different. The economy is different. But the psychology is very similar. When everyone is confident, when everyone is bullish, when everyone thinks they've figured out the game, that's often when the game changes. And there are some warning signs that people are ignoring right now. Inflation, the thing that was supposed to be dead and buried, is showing signs of stickiness. The last few inflation reports came in hotter than expected. Wage growth is still elevated. Housing costs are still sky high. If inflation stays stubborn and the Fed can't cut rates as much as the market is hoping, that entire thesis for this rotation falls apart. Stocks could get crushed, and gold could come screaming back. But right now, in this moment, the market doesn't care. The momentum is all in one direction, and momentum is a powerful drug. There's also the technical side of this that's fascinating. Gold just broke below some major support levels that traders watch very closely. When those levels break, it often triggers automated selling from algorithms and technical traders, which creates a cascade effect. More selling leads to lower prices, which leads to more selling, and so on. We might be in the middle of one of those cascades right now. On the flip side, stocks are breaking out above resistance levels that they've been testing for months. When that happens, it attracts momentum buyers, creates FOMO, and prices can run way further than anyone expects. So you've got this dual dynamic where gold is in a technical downtrend and stocks are in a technical uptrend. And that can become self-fulfilling for a while. But let's talk about what this means for you, for your actual money, for the decisions you need to make. Because that's what really matters here, right? Should you be dumping your gold holdings and chasing stocks? Should you be doing the opposite and buying gold while it's down? Or should you just sit tight and do nothing? And the answer, as frustrating as this might sound, is that it depends entirely on your situation, your timeline, and your risk tolerance. But I can give you a framework to think through this that'll help you make a smarter decision than 90% of people out there. First, understand that what we're witnessing is sentiment driven. Sentiment can change on a dime. If you're selling gold right now because everyone else is, you're likely late to the party. The big money already exited. You're selling at lower prices to whoever's buying at the bottom. Same thing with stocks. If you're buying stocks right now just because they're going up and you don't want to miss out, you might be buying at the top from the smart money that's taking profits. Timing the market based on what's already happened is a losing game. You need to think about what comes next. Second, diversification isn't just a boring textbook concept. It's your survival mechanism. The reason you hold both stocks and gold, both growth assets and safe havens, is precisely for moments like this. When one zigs, the other zags. If you're properly diversified, you're not panicking right now. You're not making emotional decisions. You're rebalancing. You're taking some profits from what's up and adding to what's down. That's how wealth is actually built over time, not by being all in on whatever's hot this month. Third, consider your time horizon. If you're 25 years old and investing for retirement, this entire story we're talking about today is going to be a tiny blip on your long-term chart. Stocks will go up and down, gold will go up and down. What matters is that you keep investing consistently and don't panic sell at the bottom or FOMO buy at the top. But if you're 60 years old and need this money in the next few years, volatility matters a lot more. Preservation matters more than growth. You can't afford to ride out a major drawdown. Your strategy should be completely different. Now let me hit you with the twist in this story, the part that almost nobody is considering. What if both sides are right and both sides are wrong? What if stocks keep ripping higher for the next few months because the AI boom is real and the economy stays resilient, but then inflation comes back, the Fed has to keep rates higher for longer, and we get a correction? And what if gold keeps dropping in the short term because of technical selling and momentum, but then becomes the buying opportunity of the decade when uncertainty eventually returns? Markets aren't binary. They don't move in straight lines. The most likely scenario isn't stocks to the moon and gold to zero, or gold to the moon and stocks to zero. It's messier than that. It's both assets going through cycles, and your job as an investor is to not get shaken out during the noise. Here's something else to think about. The investors dumping gold right now, they're not stupid. They manage billions of dollars. They have teams of analysts, access to information we don't have, sophisticated models and strategies, but they're also playing a different game than you are. They're managing quarterly performance. They're trying to beat benchmarks. They're worried about redemptions and investor flows. If stocks are hot and gold is cold, they have to rotate or risk underperforming and losing clients. You don't have those constraints. You can be patient. You can be contrarian. You can make decisions based on your goals, not on short-term performance anxiety. There's also a bigger macro picture here that's worth zooming out to see. We're living through one of the most unusual economic periods in modern history. We just went through a pandemic that shut down the global economy. We printed more money in 2 years than we did in the previous decade. We saw inflation hit levels we hadn't seen in 40 years. We saw the fastest rate hiking cycle in generations. We're now potentially looking at rate cuts while unemployment is still low and stocks are at all-time highs. None of this is normal. The old playbooks don't fully apply, so when you see a major shift like gold getting dumped for stocks, you have to ask yourself if this is a signal of a new paradigm or just another swing in an increasingly volatile market. And let's be real for a second. Gold has been declared dead so many times over the years. Every time stocks have a good run, people say gold is finished, it's a relic, it's boomer rock, whatever. And every single time, eventually uncertainty returns, fear returns, and gold comes back. Because at its core, gold serves a purpose. It's money that can't be printed. It's an asset that has no counterparty risk. It's insurance against the unknown. And in a world with massive government debts, geopolitical tensions, and financial systems built on layers of complexity and leverage, that insurance still has value. The question isn't if gold will matter again. It's when. On the flip side, stocks represent ownership in actual businesses that create value, generate earnings, and innovate. The best companies adapt and thrive regardless of the macro environment. If you own quality businesses with strong balance sheets, competitive advantages, and growth potential, you're going to do well over time. The current momentum in stocks isn't just blind speculation. A lot of it is driven by real earnings growth, real innovation, and real optimism about productivity improvements from technology. That's not nothing. That deserves to be in your portfolio. So here's the resolution to this whole story. What's happening right now with investors dumping gold and piling into stocks is significant. It tells you something about market sentiment, about where the smart money thinks the economy is headed, about the confidence level in the financial system. But it's not a signal to blindly follow. It's information. It's a data point. Your job is to take that information and ask what it means for your specific situation. Are you overweight gold because you were scared? Maybe it makes sense to trim a little and rebalance. Are you underweight stocks because you were too cautious? Maybe it makes sense to gradually add exposure. Or are you properly allocated based on your plan? Then maybe you do nothing and just stay the course. The real lesson here isn't about gold versus stocks. It's about understanding market cycles, controlling your emotions, and making decisions based on strategy rather than fear or greed. The investors dumping gold right now are making a bet. They're betting that growth and optimism will continue, that fear is off the table for now, that returns matter more than safety. They might be right, they might be wrong, but the key word is bet. And if you're going to bet with your money, make sure you understand the odds, the risks, and what you're willing to lose. Here's the mind blow to wrap this up. In 10 years, we'll look back at this moment, and it'll be obvious what the right move was. It always is in hindsight. The people who bought stocks at all-time highs in early 2000 lost everything in the crash. The people who bought stocks at the bottom in 2009 became rich. The people who bought gold in 2011 at $1,900 an ounce are still underwater. The people who bought gold in 2001 at $250 an ounce made a fortune. Timing is everything, but timing is also impossible to get perfectly right. So the real winners are the ones who stayed diversified, stayed disciplined, stayed rational, and didn't let market noise dictate their decisions. That's the real alpha. That's the real edge. What we're watching right now is history in motion, a massive capital rotation that will have consequences, good and bad, for different investors depending on what they do next. Some will win big, some will lose big, most will be somewhere in the middle. The question is, which group are you going to be in? And that's entirely up to you. Not up to some fund manager on Wall Street, not up to whatever talking head is screaming on financial TV. You, your decisions, your strategy, your discipline. So let me ask you this, and I really want you to answer this in the comments because I'm genuinely curious. Do you think this rotation out of gold and into stocks is the smart move? Or are investors setting themselves up for a major reality check? Are we at the start of a massive bull run in equities, or are we in the final euphoric stage before everything comes crashing down? Drop your honest thoughts in the comments right now because I read every single one, and some of the best insights come from you guys, not from analysts with fancy degrees. And if this video gave you a new perspective on what's actually happening in the markets right now, do me a favor and share it with someone who needs to hear this. Send it to that friend who's either panicking about their gold dropping or FOMO buying stocks without understanding why. This is the kind of information that actually helps people make better financial decisions, and the more people who understand this stuff, the better off we all are. If you haven't subscribed yet, what are you even doing? Seriously, hit that subscribe button right now because this is the kind of content you need to stay ahead of the game. I break down the real stories behind the headlines, the stuff that actually matters for your money, and I do it in a way that makes sense without all the jargon and nonsense. Next video is going to be even bigger, and you're not going to want to miss it. The markets are shifting, the game is changing, and the investors who understand what's happening right now are going to be the ones who come out on top. Make sure you're one of them.